Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 4th of June. I'm Daniel Lam, your host for the podcast. It has happened again, similar to what we saw at the time of Liberation Day. US equity positioning has recovered very sharply. Positioning has risen by plus 2.2 standard deviation from the trough in the middle of March to the current plus 1.7 standard deviation. Now, at current levels of positioning, the forward return profile for S&P 500 is skewed towards the negative, with the odds of a 5% or more drawdown over the next 3 months now elevated. We need to note that, historically, unwinds can vary in size and speed, so this is not a sell signal, but rather investors should be fine-tuning their portfolio. For example, we took semiconductors from overweight to neutral a few weeks ago because we believe there has been quite a bit of exuberance in the sub-industry. We believe those semiconductor stocks that are too exposed to memory prices would be susceptible to potential pullback, and therefore we would like to focus on semiconductor companies that thrive more on volume rather than the memory prices. And it seems that the sentiment for semiconductor names may be starting to peak. Now, from previous AI evolution experience, for example, during the taking off of smartphones, semiconductors would be benefiting first, and then platform providers or internet plays would follow. Now, we believe this will be the playbook this time as well for Gen AI. Hence, we're moving our overweight to the steadier internet plays. The key dynamic of the current rally in US equities has been the lack of breadth. From the flow side of things, institutional call buying remains the dominant marginal flow, concentrated upon growth and quality, and that makes the market susceptible to pullbacks. The key catalysts of risk for equities include Fed rate hikes, a SpaceX IPO-driven rebalancing, or a healthy rotation out of tech stocks into cyclicals. Any of these could be sufficient to trigger mechanical trend-following fund selling, which would in turn make any move lower self-reinforcing. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.